The collapse of the Soviet economy stands as one of the most abrupt and severe peacetime economic contractions in modern history. Historically, this devastation is attributed to two factors: the chronic inefficiency of a centrally planned system and the chaotic shock therapy of 1990s market reforms. But research by economic historian Marvin Suisse challenges this timeline, identifying a different catalyst entirely. This chart tracks 1990s output per capita. The red line represents the Soviet Union. Notice how far its output collapses compared to other transitioning Eastern Bloc nations. More importantly, this steep decline begins in 1989, years before the USSR dissolved. The standard historical timeline is fundamentally flawed. A massive underlying mechanism was already destroying the Soviet supply chain, while the political state was still theoretically intact. On December 21, 1991, the political reality caught up with the economic one through the Alma-Ata Declaration. In this definitive political treaty, 11 heads of state formally announced that the USSR had ceased to exist. Yet, as the data shows, the economic fracture was already well underway before these signatures dried. Standard historical narratives often confuse the political treaty as the cause of the economic fragmentation that followed. Suisse's thesis suggests something entirely different. The mere anticipation of political dissolution actually tore the economic fabric apart long before the treaties were signed, which raises a specific mechanical question. How exactly do political secession threats cause a command economy to break down from the inside out? To understand the collapse, we have to move past the macro data and examine how Soviet trade actually functioned at the micro level. Under central planning, the economy operated as a system of dynamic barter orchestrated by Moscow. Republics produced goods and shipped them across borders based on quotas, not market prices. The system had a fatal structural flaw. Local enterprise managers and Republican elites were rewarded and evaluated solely for the volume of their production output, not for actually fulfilling delivery contracts to other republics. This created an incentive structure we can call reverse mercantilism. The goal was to maximize incoming goods, which carried high utility, while minimizing outgoing goods. Supplying exports offered no return, because the trade fund money received was heavily restricted and virtually unspendable locally. Knowing this, elites utilized their executive discretion to quietly withhold a fraction of their centrally scheduled exports. These withheld resources, like raw cotton, were diverted to supply local black markets or regional networks, keeping the value strictly inside their own borders. Powerful centrifugal hoarding tendencies were mathematically built into the Soviet system by its very design. If hoarding was so beneficial to local elites, why didn't they constantly blockade trade in the decades prior to 1989? Because the Soviet Union functioned as an infinitely repeated game. The constant threat of losing future imports kept everyone cooperating with the central plan. We can model this dynamic using a standard prisoner's dilemma matrix. As long as republics A and B were locked in a closed-loop customs union with an infinite time horizon, the rational move was mutual compliance. They traded exports for imports. That equilibrium held until an external shock disrupted the timeline: Mikhail Gorbachev's liberalizing reforms, which allowed vocal nationalist movements to rise within the individual republics. Starting in 1988 and peaking in 1989, a wave of republics issued unilateral declarations of sovereignty. In game theory terms, these sovereignty declarations acted as a mathematical signal of secession sent directly to their trading partners. This signal lowered the discount factor of future interactions. The infinite time horizon shrank to a finite number. Suddenly, the rational choice shifted toward defection. Nationalism altered the math. Local elites defected, hoarding goods and slashing exports to neighbors who were broadcasting their intent to leave the Union. This theoretical model is supported by empirical testing detailed in Suisse's 2014 paper. Suisse applied an augmented gravity model to Soviet input-output tables from 1987 to 1991 to test if sovereignty declarations actually caused the drops in trade. But proving this requires clearing a severe economic hurdle: endogeneity. It's a two-way causal trap. Did nationalist declarations cause the trade collapse? Or did the economic grievances of a failing trade system cause the republics to turn to nationalism? Simply observing a correlation between sovereignty declarations and falling exports isn't enough to prove the direction of the causal arrow. To demonstrate that nationalism caused the collapse, the study required an exogenous variable, a data point that accurately predicts nationalism but is entirely uncontaminated by the trade disputes of the late 1980s. Seuss solved this endogeneity trap using an instrumental variable strategy. He utilized a highly specific historical metric, the ratio of national language school textbooks to Russian language textbooks printed in each republic in 1970. This 1970 dataset perfectly satisfies the exclusion restriction required for the model. It cannot possibly be influenced by the economic conditions of 1989. Instead, it captures the ideological baseline of a generation. A republic educating its youth heavily in its national language in 1970 was raising a population primed to demand sovereignty decades later. In the first stage, the 1970 textbook ratio accurately predicts which republics would issue sovereignty declarations in the 80s. In the second stage, these predicted declarations are mapped against input-output tables, isolating their exact impact on the collapse of internal trade. This econometric architecture isolates the causal direction, providing strong evidence that exogenous political nationalism was the primary driver of the trade network's collapse. With causality established, we can measure the sheer physical volume of the macroeconomic damage. By running a counterfactual model, the regression calculates the exact volume of trade that would have occurred if no republic had ever signaled an intent to secede. The gap between that counterfactual scenario and historical reality is defined as withheld trade, the physical goods choked off by rational nationalist hoarding. The inter-republic supply chains that were abruptly halted by this behavior operated on a massive physical scale. When these massive logistics links suddenly snapped, thousands of domestic factories were completely starved of critical production inputs practically overnight. This withheld trade metric finally allows us to map abstract political defections directly onto the physical collapse of the Soviet gross domestic product. Seuss's empirical results revealed the direct impact of this withheld trade on Republican GDP from 1989 to 1992. The numerical finding is stark. A one standard deviation increase in withheld trade cut a republic's annual GDP growth by 7.5 percentage points. This single variable of nationalist defection explains roughly 32% of the total variation in the massive Soviet GDP collapse. The economic devastation was most extreme for republics that were highly dependent on non-substitutable, bottleneck imports like oil and natural gas. Returning to the output chart we saw earlier, the vast gap between the plunging red USSR line and the higher Eastern European baselines is now clear. This shaded area represents the direct impact of withheld trade. By the time politicians met in December 1991 to sign the treaties, the integrated economic space was already a ghost. The Alma-Ata Declaration formalized a process that was already complete. Local elites, responding to the threat of secession, had already dismantled the Soviet economy from the inside out.